So let's get started. I want to make sure that I make the most of this time. I did mention before I introduce our guest speaker, that I'd like to introduce Mark Leslie from IG Wealth Management, who's going to monitor the chat box with me today. Mark, if you want to put your screen on and do a quick hello so people can see your face, that would be lovely.
I can. Thanks. Hello, everybody. Nice to be here today.
Thank you, Mark. So Mark is a 27-year veteran in financial services, 26 of those with IG Wealth Management. He holds the Certified Financial Planning designation and is also a Chartered Financial Planner and Registered Retirement Consultant. He's a former course instructor for the CFP curriculum through both the University of Victoria and Commerson College. In 2019, he granted the distinction of Fellow of FP Canada based on his contributions to the advancement of the profession. And Mark was a former chair for the IG Wealth Management Walk for Alzheimer's and has had first-hand experience with the journey in that it has affected his mother and his grandmother. So Mark, thank you for joining us today. We're very honoured to have you here.
Thank you. I will warn everybody, I'm a slow typer, but I know I'm going to do my best in the chat. So bear with me, but I will do my very best.
We'll work together. That's okay.
Perfect.
And so finally, I can introduce Bonny Stedman. Bonny was born and raised in South Africa. She moved to Victoria, BC in 2009 and joined IG Wealth Management 7 years ago in 2014. She's a senior financial consultant and financial securities advisor, having attained her Certified Financial Planner designation, as well as her Chartered Life Underwriter designation, which specializes in tax and estate planning. Bonny has been the co-chair for the IG Wealth Management Walk for Alzheimer's in Victoria since 2018, as well as a volunteer for Junior Achievement, which teaches financial literacy to grade 8 students. And in her spare time, Bonny leads an active life, participating in various distance triathlons, as well as enjoying the beautiful West Coast landscape with her dog Juno. I've had the pleasure of working with Bonny on our IG Wealth Management Walk for Alzheimer's, and I'm thrilled to have her here today. So Bonny, over to you.
Hi, good afternoon, everybody. It is wonderful to be here with you all today. I'm going to share my screen and get right into it today. We've got a lot to get through today and limited time, and it may feel a little bit like rapid fire. So I do apologize for that, but certainly if there's anything that you want to discuss after this, feel free to reach out to me. And of course, all this information will be available to you on the Alzheimer's website. Yes, this is us. Mark and I started working together on the Walk for Alzheimer's as we were at the time independent consultants, and I realized we worked really well together and decided to join our practices. Oops. So we've been working together for a couple of years now. The walk for Alzheimer's is something that we're pretty passionate about personally, but of course IG Wealth Management has been very committed to helping the society provide that vital program, the programs and services that they deliver in the communities across Canada. It's why IG does support over 300 fundraising walks from coast to coast. These walks serve as the largest annual fundraiser for the society, and the funds that are raised in those communities stay in those communities, which I think is wonderful. So since our partnership with that walk, we've raised over $5 million every year. Our vision at IG is also to inspire the financial confidence of all Canadians. We've taken that vision and extended it to our new community platform, which is the IG Empower Your Tomorrow, which is part of what we're doing today, delivering financial confidence information, workshops, seminars, and resources to communities. We want to ensure that all Canadians are able to take ownership of their finances with confidence. Just a quick little blurb about the walk, because we are starting to plan for 2022, which is just super exciting. We've had to move to a virtual platform for the past couple of years, but even doing so, it didn't stop us from hitting our targets of 5 million in those 2020 and 2021 years. So for next year, it will be the last Sunday of May, and keep an eye out for details to come from the society soon. Okay, so let's dive into our workshop for today. I'm gonna divide this workshop into two parts. The first part will discuss aspects of a financial plan, ways in which to save for retirement, available tools to help you with tax planning. And then part two will focus more on diminished decision-making capacity and how to plan for that. Again, rapid fire, ask your questions in the chat. Mark will help answer as much as he can, but we'll also try and make time at the end for questions. So before we talk about why we have a plan, we should discuss what a financial plan actually is. A financial plan is a comprehensive review of your current financial situation and projections of how a financial situation may change in the future, all the way into retirement and then beyond to the end of life. A financial plan should cover every area of your finances. So that's not just your income and savings, but we're going to look at your debt, insurance, taxes, planning for retirement, and as well as your estate. So the reason to have a plan is to establish what your financial goals are, both in the short term and the long term. And once we know what your goals are, we can review your current situation to determine whether what you're currently doing will allow you to achieve those goals, or whether any adjustments are needed. And then speaking of adjustments, your financial plan should actually be reviewed regularly to see if you're still on track. As your life changes, so should your plan. It will evolve over time as everything, both changes happen in both your personal and financial life. So if you don't have a plan, you're leaving a lot of your future financial situation to chance. So let's talk about Canada's retirement system. We're very lucky, we're very fortunate to live in a wonderful country. I certainly feel that because I'm lucky enough to have immigrated here. Canada has what we call a three-pillar system, which is three main sources of retirement income. The first pillar of retirement income are the government-administered benefits that consist of the CPP or QPP if you're in Quebec, and that's what you and your employer pay into. Then there's old age security and its supplemental benefits, so the guaranteed income supplement, the allowance for spouses and common law partners, and the allowance for survivors. With very few exceptions, every person who works in Canada and who's over the age of 18 must contribute to CPP. You may not be happy when you get that paycheck and you see that little deduction that you're forced to make, but your employer will match that. And once you retire, you will have an income stream that's guaranteed by the government of Canada. So that's pretty great. The OAS and its supplemental benefits are universal in the sense that almost everyone is entitled to receive this benefit as long as they're a resident of Canada for a certain length of time. Trickies with these benefits is that they can be reduced or eliminated for higher income earners, both the OAS and the GIS. When we look at our second pillar of retirement income, that's the employer-sponsored pension plans. So larger employers will have usually set up a registered pension plan, which the employer is required to contribute to, and employees may be required or can choose to contribute. These plans are governed by various pension legislation, but also each plan may have its own rules and requirements regarding eligibility, contributions and benefits. Smaller employees may not offer a registered retirement plan, registered pension plan, so they may offer something like a group RSP, which usually would have much lower fees than if you were to invest in your own RSP. Other employer-sponsored plans, we see the deferred pension profit sharing plan, employee profit sharing plan. We don't see these too often anymore. They're less common these days. And lastly, there's the personal savings. That's your third pillar. That's the accounts that you set up on your own and you contribute to. I always recommend that you should build your own savings in addition to the previously discussed for emergencies, as well as tailoring to your own financial goals. Probably the most common retirement savings account for Canadians is that registered retirement savings plan, or the RSP. So pre-tax dollars are contributed to the RSP. What that means is that the tax that you would have paid on that amount is refunded to you after you contributed to this plan. Contributions can then grow tax deferred until that money is withdrawn from a plan, which is presumably in retirement. The idea is to contribute to this kind of plan when you're in a higher tax bracket, when you are in the workforce, and withdraw from it in retirement when you are hopefully in a lower tax bracket. So you build room up in your RSP through generating income. 18% of your income, and there is a maximum on that, is the room that you will generate for the following year. Now that room will build over time if you don't max it out every year. Then there is the tax-free savings account. Now this account first became available in 2009, and we often say that this account should have been named the tax-free investment account. The TFSA does not provide a deduction for contributions, but any withdrawals made from that tax-free savings account is not taxed either. So every year, Canadians are getting more room to contribute to it. The current maximum available room is 75,500, which will increase by 6,000 next year to 81,500. You begin to accumulate that room as soon as you turn 18, or the year following the year that you become a permanent resident or citizen. That is something important to remember. The best way to check what your available room is to have your My account set up on CRA. This is going to be your biggest tool going forward to make sure you know what your actual numbers are. So these two accounts can work in a very complementary way with each other for your retirement savings. Investment accounts or non-registered accounts are also available to save for your retirement. The income generated inside these accounts needs to be reported on your tax returns every single year, so there's no deferral option like the first two. Juggling taxable income from these various sources, so the government, the personal, is something you may want to speak to a financial planner about. As I've previously mentioned before, and we'll discuss later on, certain benefits such as the OAS and other tax credits that we'll talk about, those get reduced as income does creep up. So it is a bit of a balancing act. So let's dive a little bit deeper into the government administered benefits. So most Canadians really look forward to getting their OAS, old age security pension. And for the most part, if you are living in Canada, if you're a citizen or legal resident, if you're 65 years or older and have lived in Canada for at least 10 years since the age of 18, you will qualify for this pension. Most seniors will receive a letter from Service Canada the month after they turn 64, which notifies them that they are automatically enrolled in the program, that they will be receiving the pension when they are 65. In some cases, you may not receive that automatic enrollment letter, so it is good best practice to be on top of your own situation. In a very few cases, you may still have to apply for it, and you can do that through the Service Canada website or in any of their offices across Canada. Now, in some cases, it may not make sense to actually take that OAS pension at 65. You can actually defer taking the income until you're 70. But like, why would you do this? Okay, well, for every month you delay receiving your OAS pension, your pension amount will increase by 0.6% up to a maximum of 36%. So this may be beneficial for seniors who maybe have enough retirement income without that OAS, or are expecting to live longer lives, or those who maybe are subject to that OAS fallback because their income is a little high. If you receive the automatic enrollment letter from the CRA at age 64, but you do not want to start it at 65, you have to send a letter to Service Canada with very specific instructions that you want to defer. The Guaranteed Income Supplement is a non-taxable supplement to the OAS that is paid to seniors who are receiving that OAS benefit. There is as long as your income is below a maximum annual threshold, and there's two different thresholds depending on whether you are whether you're single or a couple. If you do qualify for it, you will receive it OAS and GAS in one payment. So for seniors who are automatically enrolled to receive that OAS pension, they will also be automatically enrolled in the GIS program if they are eligible to receive it. So in that case, they will also get that letter from Service Canada. And again, I always say this: don't rely on receiving letters. Just, you can go on to My Service Canada, we'll talk about that in a second, and create your own account. And then you're looking at your own numbers, and you know what's going on in your situation. Okay, so most people are aware that they are able to receive their CPP pension at 65, but there is also the option to take it early at age 60 or deferring it to age 70. So, OAS, you don't get it any earlier than 65, but you can defer to 70. CPP, you can start it at 60 and defer to 70. And again, there is that either reduction if you take it early, but there's also the increase if you defer it. So unlike OAS, there is no notification for CPP from Service Canada to remind you. If you would like to receive your CPP pension at any age before 70, you have to apply for it. Those who are eligible but still haven't applied for it by the age of 70 will just automatically start to get it. And this was a change in government a couple of years ago, because really at the end of the day, there's no benefit, there's no gain from deferring it past 70. So they just sort of put you in the program. To apply for that pension, all you have to do is go online and create an online account with Service Canada. It's the My Service Canada account. It's different to the My CRA account. My recommendation, if you do nothing else after today, is to make sure you have those two accounts set up. They can be a little cumbersome to get set up because of you need an access code. They're going to mail it to you. So don't wait till you're rushing to get this information. Do it now. Anyway, you can apply up to 12 months before the start date of your pension. So if you're over 65, you can even request a retroactive payments back to a maximum of 11 months or to age 65. In certain situations, you may not be able to apply for CPP online, in which case you still have to use an application form. After the couple of years of moving everything online, I don't think we're going to see much of that anymore. So deciding when to take CPP and OAS and ensuring you receive the correct amount of benefits is very important. As these pensions, as I've said before, they form the base of your retirement income. So first, you can authorize someone else, like an adult child, a tax legal professional, or someone else you trust, to receive that information from Canada Life on your behalf by either signing into your Canada Life account your My Service Canada account by and then completing a consent form. Now, I want to say that this authorization does not give that person the ability to give instruction to Service Canada, but it at least allows them to communicate with Service Canada, get them on the phone or, help with certain paperwork. Second, an experienced accountant or financial planner will also be able to provide assistance in navigating the rules and help you plan for the best option that fits your situation. I often get asked whether to take CPP early, and the reality is there is no one-size-fits-all answer. At the end of the day, it's going to come down to your specific situation, your tax and cash flow situation, so it is important to speak to your advisor about that. So for seniors that are not capable of managing their own affairs, they may also apply to be appointed a third-party administrator. This third-party administrator may then apply for government benefits on their behalf, and that application form can again be found on the Service Canada website. So the disability tax credit is extremely valuable, and I really wanted to talk about it today and touch on a few points. It's a credit that probably springs to mind for a lot of people in this call today. This is a non-refundable federal tax credit that is claimed on the annual income tax return when there is a severe and prolonged impairment in either physical or mental functions. So being approved for the disability tax credit may allow for eligibility in additional credits and other programs such as the Registered Disability Savings Plan. So currently the amount that you can use on your returns is $8,576. That amount is adjusted for inflation every year and can decrease your federal tax owing by just over $1,200. So it is quite valuable. Applying for this tax credit involves a government form. It's the T2201, and the help of your medical practitioner will be needed for this form as well. It's submitted to CRA, who then assesses, and in some cases, they may come back and give you a time limit on how long you can use the credit before you would have to reapply for it. Lastly, I did want to mention that person is eligible for this disability tax credit for previous years that they did not claim the amount when they sent their tax returns in. They can request an adjustment for up to 10 years under the CRA's taxpayer relief provisions, and all this information can be found on the CRA website. Attendant care and tax credits can be quite tricky. I'm going to give you a high-level overview of what documents you need to make sure you don't miss out. But at the end of the day, it's always best to use a professional tax preparer if you feel like you may be entitled to this. So when someone is receiving private home or living in a nursing home or even an assisted living or retirement home, some or all of their care fees paid may be considered eligible to be claimed for the medical tax credit on their income tax returns. So first, you do need to have that disability tax credit. You need to have been approved for that credit. In some cases, certification in writing by a medical practitioner that the patient meets certain conditions is okay. It doesn't mean that you're claiming the disability tax credit. It just means that you've been approved for that claim of attendant care. So the full amount of fees paid for full-time care in a nursing home, so this is excluding things like cable and foot care, but generally all of it can be claimed as a medical expense if the disability tax credit has been approved but not claimed. So that's important. You can't double dip. You have the option of either claiming the full amount of the fees as a medical expense or the disability tax credit, but you can't claim both. And it may make sense which way you decide to go depending on your situation. Now, there is one exception to that rule where someone can claim fees paid for full-time attendant care that relate to salaries and wages up to $10,000. You can claim that as a medical expense and claim the disability tax credit. But this provision is usually used by those living in retirement homes that will provide an annual statement that give that breakdown of fees at the end of the year. And most places will do that these days. So I always say, get the breakdown from the nursing home regardless. You know, hand it into your tax preparer who's going to know what to do with it. You know, rather have it and not need it than need it and not have it, which I will say is probably the theme of the second part of our discussion today. So the number of tax rules that apply and the work that determined what documentation is necessary to go through this attendant care claim, it's confusing. CRA does do a pretty good job of discussing the attendant care in relatively easy to read language on their website. There's also the medical expense guide on their website, but ultimately, if you don't find that helpful, speak to a professional tax preparer or your financial advisor. And lastly, in this section, I want to touch on the Canada Caregiver Credit. This was introduced in 2017, and what it did is consolidate a number of former federal non-refundable tax credits, and basically it just simplified the qualification for this credit. So under the new Canada Caregiver amount, a relative must simply be dependent on the caregiver for support at any time of the year, but doesn't necessarily have to live with the caregiver. So although the government has made it easier to determine whether you are eligible for this tax credit, the process of actually claiming the credit can be super confusing. The dependent's income decreases the amount of the credit available to the caregiver, and it can end up on a whole bunch of different lines in your tax returns. Don't try and do it yourself. Get a professional to help you with that. Whew, okay, part 2. Let me take a sip here. So before we move into part 2 of this presentation, I just want to add in here that at the end of today's workshop, we will be asking you to complete a very short survey. The feedback is super helpful to us. It's helpful to the society, and we'll put the link in the chat, and then you can let us know what you thought. So part 2 now, we're talking about diminished decision-making capacity. As we plan for our retirement, a disability can come in and derail that plan really quickly. So it's just as important to have a plan in place for a disability as well. It's actually quite rare that someone goes from a situation where they are very comfortable making complicated financial decisions one day and then unable to make the simplest decision the next. In most cases, unless there is some sort of catastrophic accident, the process takes time. It takes days over a pretty extended time. In many cases, people are even aware of the fact that they're having more and more difficulties remembering things or making decisions, but they feel very defensive about their situation or unclear as what to do. So the first thing people in this situation need to do is communicate with your doctor, speak to your family, reach out to your financial advisor about the challenges that you're experiencing. So I'm going to spend a bit of time on the power of attorney role because this one is super important. It's commonly known as the power of attorney for property, although it can have different names in different jurisdictions. It's a representation agreement in BC. So this document is where one person, who we'll refer to as the donor, gives someone else, who's referred to as the attorney, the power to make financial decisions on their behalf. So if you don't already have a power of attorney in place, you should make sure that you speak to an estates lawyer as soon as possible. Don't wait too long. You may know the longer you wait, if you will lose that capacity, you are no longer to sign the document that you need to help you with losing capacity. So really, it is one of those things that you have it and not need it, then need it and not have it. If you don't have a power of attorney in place and you become incapable of making those financial decisions, your family members will have to apply to a court to take over your affairs, which can just be so time-consuming and expensive. It's also possible that that court may choose someone who you would not have chosen because they won't know what your preferences might have been. So don't delay in speaking to someone, an estates lawyer, about putting together a power of attorney document. Spouses do not automatically have the power to act on one another for one another. So even if you're married, be sure to get that power of attorney in place, giving your spouse the right to act. It's also very important to have an alternate in case your power of attorney isn't able to do so. Confirming with your lawyer that it is an enduring power of attorney. This is very important. It basically means that it is still effective even once the donor loses capacity. Ironically, if you don't have some sort of clause indicating that the attorney is to be effective even once you no longer have mental capacity, the attorney will not be able to act once this happened. So for the most part, it's when you no longer need that, no longer have that decision-making capacity that people actually want the attorney to act. So it does come as a surprise to many people that a standard form document won't be effective during one situation when they would have wanted it to be enforced. So enduring power of attorney, that is very, very important. Designating somebody as your power of attorney doesn't detract in any way from your ability to manage your assets. So as long as you have capacity, you can manage your assets. You're not giving up power. In fact, you don't even need to tell your attorney that they have the power to act immediately. In many cases, clients will register that power of attorney document with their financial institution, but will also speak to their financial advisor about when it might be appropriate to start taking instructions from the attorney. And this is super important. Make sure you go and speak to all your all the financial institutions, because places are different as well, and you don't want to have to wait until capacity is lost to start handing out this important document. Have it on file. You're not putting it in place, but at least you still have capacity to sign any institution-specific forms, and you also have capacity still to revoke power from a power of attorney if you start to think that maybe they're not the right person for you. So that essentially the problem with waiting too long is you may be creating a bigger nightmare for yourself that you ultimately were trying to avoid. The most important attribute when choosing an attorney is trustworthiness. You're giving someone else the power to make decisions on your behalf when you will be at your most vulnerable. So you want to make sure they won't abuse that power. If possible, try and choose somebody who's comfortable making financial decisions and is generally competent and organized. The person who acts as your attorney will need to account for every single dollar that they spend on your behalf. I always recommend speaking to your proposed attorney in advance, just to make sure that they'd be willing to take on that position and understand what their obligations may be, since some people do find it overwhelming. So encourage your proposed attorney to be honest with you. If they don't want to do the job, then at least tell you while you still have the capacity to choose someone else. Another important consideration is where they live. At a minimum, you should choose someone who is a resident of Canada, since it's likely that your financial advisor won't be able to take instruction from a non-resident of Canada. Now, if the attorney is a resident of the US, or even just a US citizen that happens to live in Canada, that could create even bigger complications. I won't get into it, but basically, in a perfect world, you should pick somebody that lives in your home province, simply for ease of administration. Consider the attorney's own financial situation. If the attorney is struggling financially, that may indicate that they aren't good money managers, and that they may be under more pressure to misuse your assets for their personal benefit. And it doesn't even have to be with bad intentions. Sometimes it's just not understanding their fiduciary duty to the donor. This discussion can cause people quite a bit of stress, especially if they don't have a close family member that lives close by, or they don't feel comfortable, or someone that doesn't feel comfortable taking on the job. In some cases, the only close member of the family that they have is older than them and may not actually have capacity themselves when you need them. So if you find yourself in this situation, speak to your financial advisors, speak to your estates lawyer, because you can access or be referred to a corporate attorney, such as a trust company, and they can take over those duties. There is usually a small fee to act as your attorney. Okay, this is a hard one to talk about, but it is important and it does happen. And the best way to avoid financial abuse is to make sure you choose someone that is trustworthy. However, the issue is a little bit more fundamental than that, in the sense that there are a lot of people who want to do the right thing. As I say, they're good intentions. They've just never received any education on what an attorney can and can't do. So for this reason, it is recommended that you sit down with your attorney and explain that when the time comes, you would like them to manage your affairs on your behalf. But they should also speak to your financial advisor and even potentially your lawyer and accountant for assistance on how to properly manage your assets. In particular, attorneys need to understand that they can't obtain personal benefit from their position, and they can only use the donor's resources for the benefit of the donor. And we see it, unfortunately, requests come in for large redemptions, and they are denied until the attorney can justify why they need so much money. And to be clear, how they use that money must also benefit the donor. So just the donor and their dependents, but not the attorney. It may also be a good idea for donors to take their attorneys to meet their financial advisors and discuss what will happen in advance. It's always helpful if your financial advisor knows who to call in the case of emergency. So having that meeting and confirming contact details is just good practice to start off. Having that meeting with your financial advisor in advance also allows that advisor to confirm with the donor and the attorney right there in the room that redemptions will be limited to what the donor reasonably needs. And if the attorney asks for any amount that seems out of the ordinary, they will be denied until they can be justified. At these meetings, it can also be stressed to the attorney that is only to act on this power of attorney that can only take an effect once that donor has lost capacity and no time before that. Attorneys, like I said, they need to account for every dollar of your money that they receive and every dollar that is spent. Attorneys can't do things like transfer assets into their names, and they generally can't do things like change beneficiary designations, add themselves or anyone else as a joint owner on an account, or especially not borrow money from the donor. So once that attorney understands their roles in advance and are warned of potential liabilities they will face if they abuse their situation, they are much more likely to act appropriately. Part of what I've included today, which will be available on the Alzheimer's Society website, along with these slide decks, so you will have access to this. I've included a document called Duties and Responsibilities for Power of Attorney for Property. This is a really handy document to help understand what that's all about. I have to talk about joint ownership because we see this request so often. As a general rule, adding children as owners to property is a bad idea. It's one thing to add your spouse as a joint owner, or at least when you're not in a blended family and there's you may want assets to go to different people, but it's another thing to add your child. If a client wants someone to manage their money, if they aren't able to do so, the solution is always appoint that attorney. There is no reason to add a joint owner. There have been quite a few court cases where disputes arose because the child started to experience their own creditor issues when they were getting divorced. And parents were very stressed to find out that their child's ex-spouse was claiming entitlement on their assets. There was a case right here in BC where a mother had added her son as a joint owner on her home, and he wasn't even aware of this, but all of a sudden his creditors were putting a lien on her house because his business was starting to go into default. So it's just a tricky situation. I wouldn't recommend it. The other thing is once you add a child as a joint owner, you still need that power of attorney in order to manage assets. So it doesn't actually help your situation. For example, if you added your child as a joint owner on, say, your home, and you would still need to appoint your child as power of attorney in order to consent to the sale of the home if you moved into assisted living. So long as your name is even partially on title, you need that power of attorney. So joint ownership arrangements can make your estate plan much more complicated. Was the intention that the child added as a joint owner receive assets outside the estate, or is it to form part of or portion of their inheritance? The other issue is that financial abuse. It's so much easier for funds to be misappropriated. And the other thing is once you add a child on these accounts, you can't take them back. You can't change your mind. You would have to go to court in order to have your child, the joint owner removed, and you don't actually even know that the court will agree with that. And there have been cases where the courts have not authorized that request. At least with a power of attorney, as long as you have that capacity, you can revoke the power. The risk of incurring thousands of dollars of litigation costs just generally isn't worth trying to save a few $1,000s of probate, even in our 1.4% probate province. And then transferring assets to a family member, again, I would say don't do it. You are completely giving up control of your assets. You're essentially giving an early inheritance to your child. They own the money. That's your control gone. People sometimes do that because they think that nursing care costs are asset based as opposed to income based, but in most jurisdictions they are based on income. And yeah, we got to talk about it. Financial abuse, it happens. There we go. It is, unfortunately, the sad reality is that it is often perpetuated by close family members or friends. But there's also a lot of financial abuse that happens by third parties. And these types of criminals, they're very sophisticated. Clients can feel embarrassed by for talking to talk to their friends and family about what may have happened, possible financial abuse. They may feel that it's, they were silly to let it happen. But keep in mind that many intelligent people have been the victims of financial abuse. So there is really nothing to be embarrassed about. One of the main tactics these abusers use is to isolate their victims and then convince them that they can't tell anyone what's going on. It's a massive red flag. If someone is telling you you can't talk to your friends and family about how you spend your money, if they're telling you to lie to your financial advisor, that is a scam. And it is very important to make sure that you are communicating with family and with your financial advisor. There's also things like romantic scams out there, so be wary of any Facebook friends whom you've never met in person. As we move to this online virtual world, it has really just become a bit of a scam playground for these guys. So if you think something is suspicious, the first thing to do is speak to your family, speak to your financial advisor, or call the police. The worst thing that can happen is that they tell you that there's nothing to worry about. Okay, so as we come to the end of our presentation today, I want to go over where you can find information that we've addressed, because it is quite a lot. It can be very difficult to find good advice, but we do know that the Alzheimer's Society of BC website is a wealth of information. You'll be able to find today's presentation as well as that duties, responsibilities of power of attorney that I've included. I also included create your own retirement income plan and financial future checklists. First link, dementia helpline, is available Monday to Friday, 9 a.m. to 8 p.m. And that is a cultural and language support for Canadians. We did talk a lot about CPP and OAS. These pensions are administered by Service Canada. So Service Canada is the place to go to find that information. Other tax credits or income tax information that you need is on the CRA website. And if you want to look and make sure that you are, there are other regulators that monitor various areas of the financial world. If you want to take a look at those, the Canadian Bankers Association, Financial Consumer Agency of Canada, and then each province and territory has their own securities commission. Lots of good information on those websites too. Having the facts on policies and rules doesn't help you interpret how they may apply to your own situation. Sometimes it can be difficult to understand the information that you've accumulated. And so in many cases, it is best to see a professional for advice to determine how to proceed. When trying to find a professional that you can that can give you that good advice, make sure the professional is educated in the area on which you need expertise. So don't go to an accountant for legal advice. Don't go to an insurance agent for tax advice. So once you've found those professionals, ensure that they have sufficient education and are able to provide good advice. Have a look at their designations. What are their credentials? Look them up on LinkedIn. Let's take a look at their history, how much experience they have. You can go on to the Canadian Securities Administrator, and there's a national registration search function, and you can see who is licensed in what provinces, and see if anybody's been disciplined for anything, breach of regulation or ethics. So like I say, choose the professionals with the right credentials. If you're choosing a financial planner, make sure that they are a certified financial planner. When choosing a lawyer, make sure that he or she has that trust and estate practitioner designation. You want to make sure that you're getting advice from people who really do specialize in that area. So some lawyers may dabble in wills and power of attorneys, but sometimes that advice that they can give isn't helpful. There are a lot of people who do specialize in helping people cope with aging, so don't just pick the first person you happen to meet. Ask them what their area of expertise is so that you can make that informed decision. Whew, okay, so thank you so much, everybody, for coming out today. It has been my absolute pleasure to present to you today. I know it has been just a waterfall of information. We do have a bit of time left to answer some questions.
Bonnie?
Yes.
There was a comment about, let me scroll back to it, something from the presentation that I missed because I was typing, and it was the name of the form that a care facility gives to you that basically gives you the amount of deductible expenses.
Yeah, it's not actually a form. It's really just you want the year-end invoice, essentially.
Yeah. And actually, I can speak to this from personal experience. I was the power of attorney for my mother who lived in a care facility. And every year, it wasn't something we had to request. We just received in the mail a form itemizing her annual cost of care. And they distinguished between, what the medical side of the cost of care was. So it made applying that to her tax return very straightforward.
Yeah, most places are doing it these days, which I think is fantastic. I think they probably just got tired of multiple people asking for it, so now it's just a given.
I see a comment here about individuals with a disability, and I would presume claiming the disability tax credit. Do they also get CPP and OAS? And the comment would be that they are completely unrelated. A tax credit, like the disability tax credit, just increases the amount of the tax-free income that you can bring in as an individual. So the threshold at which you would pay taxes at, the qualification for the CPP and OAS benefit would be completely exclusive of that. So I see a comment also about the Canada Pension Plan, its conversion from a disability benefit to a retirement benefit. And that's an automatic change that happens to the benefit at age 65. And often it's a reduction. The disability amount, in my experience, has often been a greater amount and to the tune of $100 to $300 a month more than what the retirement benefit turns out to be. So people with a disability receiving disability CPP often see a reduction in their CPP at age 65. Does dementia qualify for the disability tax credit? And yes, it does. I basically, and it's not dementia as a defined condition. It's there's a form and it's basically the need to have assistance with more than one daily activities of living, and those are feeding yourself, etc. And the doctor would help you fill out the form. In fact, you need a doctor's signature to complete the disability tax credit application.
Yeah, just looking at a comment here that shocked that spouses aren't automatically power of attorneys, and yes, I've seen that before where a husband had a heart attack that left him completely incapacitated, and then the wife wasn't able to sell the home because it was a joint asset. The mortgage was held jointly, and it became a huge nightmare because they didn't have power of attorney set up for each other, and you know, this was a case that was just a horrible accident, and so don't assume that spouses have that authority.
Yeah, and I would really emphasize that it really makes the power of attorney one of the most important legal documents that you may fill out in your lifetime. Bonnie's example is a glowing reason why. You know, but then some people, you know, spouses included, keep their finances completely separate from each other. And, you know, so I guess that would be the justification why it's not an automatic, but certainly an important one to investigate.
There is a comment here asking if there has been financial abuse, is it the power of attorney who will pursue action? I would say that, you know, depending on who is being accused, you definitely want to speak to get legal advice on that. If you know, it doesn't necessarily have to be that power of attorney, but if you suspect it is the power of attorney that is abusing their rights, then I would make sure to you know, speak to an attorney about that.
There was another question about what qualifies you for the disability tax credit, and again, I believe that's you know, 2 or more of the daily activities of living, needing assistance with, and again, a physician would help fill out that form. If you download the disability tax, we gave you the link for CRA. If you Google the disability tax credit application, it will list basically the description of the benefits and describe exactly what the qualifications are. But again, you would need your physician to sign off on it.
Thank you so much, both. I'm really sorry. I'm going to have to cut in here, just looking at the time. But sorry to do that. But it seems like there was lots of information and lots of questions. And just a huge thank you to the both of you. That was lots of information shared. I took a few notes myself, and just a reminder to people that we will have the slides in that useful document link that I shared, so you can kind of go back and have a look. But yeah, some useful information there, so thank you. In that document, there's things from the Society too, like personal planning along the dementia journey, strategies for difficult conversations, who to contact if you have questions about plan giving or leaving a gift in your will, as well as all the documents that Bonnie described today. So lots of information for you. Thank you, everybody, and enjoy the rest of your day.